What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is April 3rd of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I'm going to talk about the number one dynamic that is going to determine where Bitcoin's price goes in the coming future, and one of specifically the charts that you need to watch when you're trying to determine whether or not we're approaching a temporary top or a temporary bottom. Not always just bull market tops and bear market bottoms, but short-term waves as well. So this is critical for any short-term or swing traders out there like myself in the market. We've got a lot of things to dive into today's video. If you guys like this video, consider dropping a like, and let's go ahead and kick things off. So I want to go ahead and kind of pass on doing the traditional TA or price analysis here. We not only do that quite routinely here on the channel, but there are also tons of other content creators out there who will tell you that Bitcoin's price is going here in the near term. Here is the technical pattern that justifies why Bitcoin is going to do what it's going to do. And as you all know, while we do use technical analysis to some degree, we like to focus more on deeper dynamics. We like to go beyond just simple price analysis. And one of the ways we can do this is by measuring things like market order flow, and more broadly speaking, asking the question about liquidity. Now, I want to go ahead and dive into that first topic here of market order flow, because the bigger topic we're going to be talking about is liquidity, and more specifically, whether or not liquidity is increasing in any given market or contracting, and what measurements can we utilize in order to determine this. If we can understand this, we will have a massive edge on the broader market that does not follow these types of metrics or understand these concepts. So let's go ahead and first start by talking a little bit about checking into market order flow. Now, if you guys routinely check into the channel here, you guys know that we work with a long-term partner of ours here in the channel, which is Bookmap. Now, Bookmap is not just some partner here in the channel for any given reason. It is a specific tool that allows you to analyze market order flow across the exchanges. And some of you might be wondering what market order flow really is. Market order flow will allow us, through what's known as the cumulative volume delta, to measure, generally speaking, if there are more buyers or sellers at the best available price. Now, there's always going to be a buyer and a seller in every trade. That's a fair point to make. But it is important to understand who is forcefully engaging in their trade. Essentially, rather than someone who might have a limit or bid order, a bid or ask on the order book, which is a form of a limit order, where they're willing to buy Bitcoin at a specific price lower than the current market rate or sell at a higher rate versus the current market rate. The market order flow is people who are willing to take the best available price and exchange whatever asset or currency they have for the other type of asset within the pair. So in the case of a market order flow purchase, in this case, let's say I have $1 million here. I'm willing to buy the best available price for Bitcoin on the exchange that I'm trading on, and vice versa. If someone was to do a market order flow, a sell to the downside, they would be holding $1 million for the Bitcoin, roughly speaking, and taking the best available price they can get. Maybe they don't get $1 million exactly; they get 999,950 bucks, right? Something along that, minus exchange fees. So that's generally how markets work. It's a mixture between market order flow and bids and asks on the order book, which are the form of limit orders. Now, that is what makes a market. It's what helps determine price. And as we can see here, if we take a look at the cumulative volume delta, this is our first warning sign here, which is that, yet again, we not only have weekly cumulative volume delta over the last 7 days, but I'll be honest, I'm not going to be able to doom and gloom here. It's relatively neutral, right? But that does not negate the fact that there is a bit of a disparity going on between what people are claiming, at least the bulls in this case are claiming is going on in the market, versus what's really going on right now. Right now, we are not seeing some massive bank run of dollar liquidity into the crypto industry. I know a lot of people are telling you guys this, are screaming it to the roof that you got to get your money out of the banking system, go all in on Bitcoin. Balaji said that Bitcoin's going to $1 million. Folks, I'm not saying that there's no chance that Bitcoin could become this hedging asset or that it could deviate away from other asset markets and become this kind of digital gold. That's something we've been talking about since as far back as 2017 here on the channel. But unlike a lot of people who continue to chase the same narratives and ignore the fundamentals of markets, we actually try to dive through and see whether or not these narratives hold up. Are there people en masse buying? The cumulative volume delta across the multi-book tool, which is analyzing some of the biggest exchanges by spot liquidity like Binance and Huobi, is telling us right now that it's not happening. And you see this across Coinbase and so many other exchanges when you analyze that cumulative volume delta. That's problem number one. So we're not seeing some mass forced buying that's just clearing through and driving prices higher. Once more, over the past couple of weeks, not only have we had cumulative volume delta, but we have been seeing a pretty consistent pattern here on the overall price alongside the heat map. Now, the heat map is a visual representation of the changes in the order book for Bitcoin's price. Now, the order book is significant because these are those bid and ask orders or limit orders that we discussed about earlier. These are what allow for significant degrees of support and resistance on price. And while the order book can change, and sometimes people can spoof, essentially setting certain orders at certain prices and then removing them, most of the time with the heat map, especially when analyzing tools like Bookmap's multi-book tool, you're able to spot when there is forms of distribution. And this is very important for us to watch for when it comes to relief rallies or even just broader uptrends in price to understand when we're potentially hitting resistance beyond just analyzing price. And this is where we can see it playing out in full swing, where it is playing out in broad daylight. First off, you have a market wave of optimism as people, or more specifically, retail traders, could be institutions as well, those who believe the price is going up, they start market buying here in the short term. Now, first off, this is a sign here of optimism. At the end of the day, it is something that is driving up price. However, watch what happens when this market optimism comes in. It comes in to fill the order on the order book. So someone here just was able to sell a ton of Bitcoin into buying pressure. Now notice what happens after that. Notice how there isn't enough to follow through, but rather we see continued downward pressure, and a lot of that optimism faded within the next wave of price. On top of that, we have another wave up here in price that comes up to the order book. The order book is now even heavier than it was before. Hundreds more Bitcoin than were there previously. And that's why, again, the heat map looks a bit thicker, looks a bit hotter here. Essentially, there are more Bitcoin now at the exact same price range. But price has no ability to get above and clear through that market pressure. Essentially, someone not only took advantage of that buy-side pressure, but secondary, they took the opportunity to continue unloading into price. Right? As you can see, the market order flow continued afterwards and is continuing here as we go here to the right. Simply put, distribution doesn't always look exactly the same, and you have to learn how to spot these kind of patterns. But essentially, we can see here that price action is being taken advantage of. This optimism on the other side of the trade is satisfying another trader who's trying to close out and get out of their positions. And if this continues to happen enough, if that resistance keeps happening there and price is not able to get above it, price is going to move lower, generally speaking, or it's going to stay there. It's not going to be rallying higher. This is a prime example of why I really dislike the kind of false narrative that's being shared around. Even though price action did expand over the past couple months, we did have positive cumulative volume delta for the past couple weeks. And we're going to be the first to say here that, yeah, we didn't trade the rally to the upside. Fair point. But it doesn't negate the fact here that over the past 2 to 3 weeks, we have seen neutral or negative cumulative volume delta. And this was the exact same pattern we saw during the bear market, albeit just more aggressively. It's always going to be very soft at the beginning and pick up further and further pace to the downside when it becomes clear that price can no longer expand, that there are more net sellers than there are more net buyers when it comes to that cumulative volume delta, as well as order book pressure. Now, I want to go ahead and focus in on something that I think the vast majority of crypto content creators, traders, and investors do not watch. I think it is a chart that probably 98 to 99% of people out there in the crypto space have not seen. And it is going to be the determining factor that's going to allow you to help figure out when Bitcoin is approaching bottoms and when it's approaching relative tops. Today we're going to be talking about stablecoin liquidity. Now, we've talked a lot on this channel already. You've probably seen me talk about this before, and I'll go ahead and turn off the drawings here so you guys can see it. You've probably heard me talk about USDC and USDT in the total market cap, right? Now, market capitalization for stablecoin liquidity is an important measure here because it's letting us know whether or not the overall increase in liquidity is enough to sustain a broader uptrend, and vice versa. If we're seeing a contraction of liquidity, this can be a sign that we're not ready for a bull market, that there isn't some mass inflow of capital which is needed to drive bull markets. We can see that quite clearly here. Since the previous bear market bottom in December 2018, some of you might have been watching the channel as far back as then as well, when we were trading during that period of time. And many of you will remember that during that period of time, we had an increase of stablecoin liquidity all the way into March of 2022, taking stablecoin liquidity from just a mere $2.5 billion all the way up to $134 billion. Not bad if you can get it. That's the kind of liquidity we need to really drive a bull market. And I'm not saying we need to have that kind of expansion, the same percentage of expansion, or let alone we need that to happen next week, right? This took time to play out here. However, there's a very unique way we can start to measure this over time. And first off, we just have to start with the basics here. Let's go to this question here, whether or not we're seeing any stablecoin liquidity expansion, right? I know some people think that, but when you're buying Bitcoin, you don't need stablecoins. Like, you only need that for altcoins. But even back then, guys, when altcoins were not faring well, and when Bitcoin was really leading the way like it is now, right, during the previous capitulative period in this market, we saw a 100% expansion in stablecoin liquidity during that relief rally. Once more, if we take a look right now, we're not seeing any increase in stablecoin liquidity. In fact, it has been contracting since back in March and is relatively flat with where it's been since back in October. So no mass inflows, no bank runs of people taking money from traditional bank accounts, injecting into stablecoins like USDT or USDC in order to go out as an on-ramp to buy Bitcoin. We're not seeing this, right? And this is, again, as we pointed out, not just through the market order flow, but generally through volume. Spot volume has been very thin. The order book is relatively thin, which is why the price can be incredibly deceiving. Once more, we need to ask ourselves the question of whether or not we're going to be able to have this kind of expansion or something, even 1,000% expansion in stablecoin liquidity, right? If we wanted to see 1,000% increase in stablecoin liquidity, you're talking about taking this up to $1 trillion. I understand some people are saying with the whole bank run narrative that could happen, but we certainly aren't seeing it now. When Silvergate Bank, First Republic Bank, some massive banks with hundreds of billions of dollars of assets have effectively gone under or gone under restructuring. And if that's not enough to spark a bank run, what is going to be enough? Now, this brings me to the chart that you guys should definitely keep on your radar. And again, is one that I think the vast majority of people have not seen. And that is tracking, more specifically, the dominance of USDC and USD Tether. Now, I'm sorry for going from the dark screen to the bright screen there. I try to give a warning ahead of time for that. But the main thing I wanted to go ahead and talk about, just so you guys can utilize this yourself, is I use a different website for this because unfortunately, TradingView doesn't have the extensive history that we need for this chart in order to really gain a lot of valuable insights. So you can use this on a website that we've used on the channel here before called charts.cointrader.pro. So if you just simply Google that, you'll be able to bring it up. It's a really simple website. It uses TradingView's interface, so it probably looks familiar. But generally speaking, there are two things we need to type in order to generate this chart. So in order to pull up this chart onto your computer, all you have to do is type in USDC, use the keypad to go down towards dominance, hit plus, and then type in USDT, and do the exact same until you see Tether Dominance CoinMarketCap. Once you press enter, you'll be brought up to this chart here. However, we've done some custom technical analysis here that again is going to give us the guideline and framework to understand how this indicator can be very valuable in tracking where Bitcoin might be heading in the near future and whether or not we're getting towards swing trading opportunities. So first off here, this takes us back as far as 2015. Now we can see throughout time, stablecoin dominance continues to ascend higher. And this generally makes sense. As Bitcoin is becoming a larger and larger asset, the overall market share of stablecoin liquidity is going to be needed. And it's just going to continue to swallow up more market dominance, especially if we have waves of altcoins and other value creation within the crypto space. In order to sustain those valuations, there has to be some general increase, more likely than not, in stablecoin liquidity. At least that's what history tells us. But more specifically than this, history tells us that there is a clear defined band in each bull market where we generally see price start to face resistance or provide ample buy the dip opportunities that can allow us to make some great swing trades utilizing this dominance metric. Now notice the red dots that we've highlighted here throughout the chart. If you go back through Bitcoin's history, and in fact we can actually go ahead and compare BTC here. So we're going to go ahead and just bring up the Bitcoin price action. And what we're going to do is we're going to bring this on a separate pane. Separate panel. So we're going to do a new pane below, and we're going to turn it to logarithmic scale, so it makes it a bit easier for us to see this. And we're going to go ahead and put this back on a regular framework and go ahead and switch it back to log. All right, so there we go. We've got everything all set up here. Now what's really interesting is if we look throughout this period of time, notice how when we have these red circles, there are usually periods of time where Bitcoin is quite overheated. For example, we saw this here during June of 2017 during the rally towards around $3,000, and we saw it here in December of 2017 when we set in our bull market peak. And as time progressed, although the acceleration rate during the next bull market was at a slower pace, we could see that this timed the top in June of 2019. It timed the top here in February of 2021, or generally when we set in our first major cycle high. And as we came up to retest that range as well, it gave us the same warning sign. And last but not least, if we take a look here, we're coming down yet again towards retesting towards that potential top. So essentially speaking, while I don't want this to serve as an absolute goalpost, there is no absolute guarantee of anything. There's no one indicator that's going to tell you everything. What this does show us is that we're likely approaching a relative high here for this cycle. Not to mention, if we're expecting that we're going to be building a slower channel that's more flat over time, we should be approaching that low sooner rather than later, even if we're going to be going off of a new channel here versus the current one that we've been watching here since as far back as 2018. Generally speaking, unlike back here in June, where we were back towards the highs of the band, where it was a discount opportunity, we are now at a pretty expensive and overbought period of time. If you need anything to help you dispel the FOMO, that right there should be the method. That's what should help you guys bring yourself back to reality here. It's the same thing back here in June, right? Remember back in June and July when we bought the dip, the 50% correction here, right, and rode the wave higher? That's what allowed us to essentially pick that bottom and know that generally speaking during that period of time, at least that relative bottom, it was time to get long. Same here as well with September 2020. This was again your sign here, similar back to March of 2020. Both of these were relative ranges where afterwards Bitcoin expanded rapidly as we approach the upper band of that line of dominance. And why is that? It means that there's tons of flush cash. And comparatively throughout history, this is the most cash we've had versus Bitcoin's current price or current valuation. It means that there is a ton of liquidity, and comparative to that increase in liquidity, Bitcoin's relatively cheap, and that there might be an opportunity for price to expand higher. This also was what timed the bear market bottom in December 2018. Now, to be completely fair with you guys, this indicator becomes more and more useful as we start to formulate channels. Sometimes, as we mentioned, we've seen two long-term channels here, usually a definitive for each each bull market. So because of that, we do need more time to actually have that indicator, or at least this channel starting to formulate. And it becomes more useful for us if we can continue to check back in on it, and as we have more established higher lows and higher highs, establishing essentially a new channel. So again, that's where there can be a bit of an anomaly, and it's why I don't talk about it being a perfect indicator, but it is a clear telltale sign that right now Bitcoin is likely expensive. It is not a time to feel FOMO. Where you should be feeling FOMO is when no one is willing to buy. And for those of you who did dollar cost average, for those of you who are swing traders who bought in on that dip in June, hats off to you. The only reason we didn't do this was because at the end of the day, the entire crypto ecosystem as a whole was going through a massive restructuring period. And we didn't know how bad the contagion really was. 6 months later, after the collapse of names like Celsius or Voyager, FTX went under. And again, this kind of contagion can be enough for you to just want to kind of sit back. Doesn't mean that you have to chase every rally just because we have this great metric that is giving us some really good insights to where lows and tops may be. Now, I want to go ahead and step in towards talking a little bit about the macro here, because this is where we really need to have our focus. I understand a lot of people are maybe still going to disagree with me about, the kind of micro analysis of crypto. Some people think that, I'm being too stubborn here and that I'm missing the broader rally. And to be honest with you guys, as I mentioned, maybe it could continue to accelerate higher. We're not closed off the idea we could go up to around 30K here with the momentum we've had. That being realized, I'm not betting my money on it. And I'm especially not doing it considering the macro conditions, because I know a lot of people are estimating that the Federal Reserve is going to pivot. A lot of people looked at the recent inflation report. We had a slight beat on inflation of about 0.3% versus the 0.4% that was expected. But no matter if it's 0.3%, 0.4%, 0.5%, or 0.6% or 1% or less, whatever it may be, at the end of the day, having these kind of month-over-month increases means that the Fed has not done its job yet, especially when you're talking about the PCE, which is much more sticky. Essentially, we can see if we take a look at US 2-year Treasury notes, right? US government bonds, we are still where we were back on the bottom, essentially, of the flash crash we had from March 9th to March 13th. Rates have been relatively suspended, and they're showing resilient strength on that 200-day moving average. That is not a good sign for the bulls. That is essentially meaning that the Fed still is pricing in, the market is pricing in that the Fed is going to continue tightening. Once more, if we take a look at the dollar index has established what appears to be a higher double short-term bottom versus the previous lows back in February, where we had huge buy-side pressure for multiple weeks. So again, I'm not here to absolutely say that you need to go FOMO into the dollar or go buy government bonds, but these are more specifically serving as indicators, contrary indicators to a Bitcoin bull market, that the Fed is going to likely continue hiking rates. Hiking rates and reducing its balance sheet is not good for Bitcoin. That's what stimulated Bitcoin when we were basically reducing rates and adding to the balance sheet. Doing the complete opposite historically is not going to be beneficial for asset markets, especially not for Bitcoin. And once more specifically, if we are tightening, that is going to give a better advantage to those who are exposed to treasuries and dollars, whether it be in the yield that those bonds pay or in the base currency itself. Now, I want to go ahead and talk about another key dynamic here, which is the yield curve inversion, which had gotten to its widest extent we have seen in a century, down towards minus 1% between the spread of the 10-year yield and the 2-year yield. Again, I just want to reiterate with you guys here, this metric and its eventual move to the upside like we saw here in March is one of the most consistent indicators throughout the history of macro analysis that we have that proves that a recession is around the corner, or more specifically, that a recession is due within the next 6 to 12 months. So if the environment right now is already looking concerning, go ahead and price in the next 6 to 12 months that we're going to have a real earnings recession, that we're going to have a real economic contraction. I'm not saying it's going to be like 2008 or whatever most relevant recession we have. Every recession is different to some degree. History doesn't always repeat, but it certainly rhymes. And we know that during these contractionary periods, they lead to recessions, and they likely are not beneficial for asset markets. I know everyone wants to rush to the narrative that Bitcoin is going to be this savior asset. But at the end of the day, we need to look at history. And Bitcoin had its best performance. It served as the inflation hedge when the money printing actually happens, because markets are much more efficient at pricing that in. but they're not going to accelerate during this period of time when we're in a contractionary wave of monetary policy. Once more, on the topic of inflation, oil, just this morning, as the markets have started trading, has spiked up around 4 to 5%. The reason for this here is because of the fact that OPEC just announced a surprise cut of 500,000 barrels of oil each day. 500,000 global barrels of oil production eliminated just like that. Oil prices are back up into upper double-digit territory, bouncing strongly off of that 200-week moving average. This is not what you want to see if you're trying to make the argument that inflation is done with and the Fed has got it under control and that they can start to pivot. I think it's quite the opposite here. The Federal Reserve still has work to do. There is still an imbalance between supply and demand. And until that is met, until that is fixed, until that is properly addressed, and the Fed gets in the driver's seat of dealing with inflation, we are going to continue having accelerated inflation. Once more, for those of you who are looking at stocks and thinking about buying the dip, take a look at no further than the VIX. Take it here to the weekly here. We have continued to talk about this upward line of support signaling a major volatility event in the near future. We don't know exactly when it will be, but generally speaking, when volatility comes into this band, we usually see it spike up within about a week or so. So yeah, maybe you can buy into Nvidia stock and all those stocks that have already rallied 150, 200% and chase the trade and convince yourself that we're in the next bull market. But if we look at the VIX, you're stepping into an environment with incredibly low volatility in the near term, but in the long term, expanding volatility, which likely means that you're buying at pricey levels. You're buying at expensive levels. If at a minimum, you can wait until we get some kind of dip opportunity. Wait until we get contractionary periods. Again, if you guys don't have the conviction to be able to buy in on those dips, right, when things aren't feeling good, don't be so easily convinced to spend all your money when markets are doing well. And again, I want to emphasize it here, guys. It's all about patience here. And it's all about being able to find ways to analyze the market beyond what every other trader is already using. Tools like Bookmap, which you guys can get access to in the link down below in the description. You get 20% off your subscription. And I think one of the big things here to understand is that at the end of the day, those who are patient and can wait for the long term are really going to benefit most. We watch all these metrics that take us outside of the crypto space because it gives us an edge on understanding how liquidity and also investor sentiment really is. How strong is it? And when we get that real capitulation, that is when we're going to strike big time. Now, if you guys haven't already, we just recently published this month's edition of the Dash Report. This is our newsletter here on the channel where I do a 360-degree analysis on financial markets. If you have made it this far into the video, you're likely the prime candidate to subscribe to the newsletter, because what we do is we don't just cover crypto markets, we cover equity markets, commodities, forex, we cover opportunities in a whole range of markets. And as I've emphasized before, not only do we have the newsletter here on the channel, we also offer mid-month webinars. We do some exclusive market updates, sometimes more actively during bull markets than in bear markets. But we have a Dash Report discussion group where you can talk to some of the smartest individuals in our community, hundreds of Dash Report members who are also tapped into markets, watching opportunities and sharing their thoughts, all kinds of stuff, as well as our trade alerts here on the Dash Report. But the big thing here that I want to emphasize is that if you guys are someone who is tapped into the macrosphere, who is eager to get that additional edge and really likes the content we produce here on the channel, you'll be able to find metrics like this stablecoin dominance metric on the Dash Report earlier than here on the channel. We really try to share our biggest alpha within the newsletter, but we also do a ton of free content here on the channel. Think of it as an additional 20% on top of the 80% of content that we focus on here in the channel. It gives you that additional edge and lets you know what kind of actions I'm taking in the market. So that's it for today's video, guys. Thank you all so much for watching. If you guys enjoyed this content, consider dropping a like. It's one of the best ways you can support the channel. But until the next video, everyone, thank you all so much for giving me some time to ramble, and I'll see you all in the next video. Take care, everyone.